Now, big picture, if you look at the asset class, I think one of the biggest concerns right now is the public markets and how they've been running. And it's very difficult for a private equity program, particularly one that's slightly younger, to be able to keep up with 20% type of returns in the public markets. It becomes a benchmarking problem. Boards don't always understand it. That comfort level with the asset class when not meeting benchmark or that spread is not comfortable or is growing in the wrong direction, is a bit of a concern for us now. And we spend a lot of time on education and perspective and valuation policies and lagged valuations, all sorts of things in terms of helping clients continue to be comfortable with the asset class when private equity perhaps isn't looking as quickly good as perhaps the public markets have been. So that's something over this last year we've certainly seen. On the positive side of private equity, it really feels like, and this is looking across the global markets, I work with investors in Australia and Japan and Saudi Arabia and across the US, it feels like private equity is no longer that black sheep. We're actually getting a little bit of positive momentum post the financial crisis. Many programs have been started, and quite frankly, if they were started at that 08-09 period of time, many have actually done quite well. I know a number of our clients have. And so private equity has seen some returns, and boards and investors are starting to say, oh, private equity can get me returns that are greater than the public markets. I can actually see it, and I'm getting liquidity out of the program. That really just makes everything feel a lot better. Venture capital has probably been a bit more interesting of late than we would have seen it perhaps during the tech time. We like to see a little bit less competition. We like to see the smaller fund sizes that have certainly come back. At the same time, whether it's the social media, it's the healthcare and the technology that's being brought to that, there's some very fundamental issues that are being addressed by venture capitalists, and whether it's in the earlier stage side, into that evolving kind of growth factor for venture capital as well. Interesting areas, a fair amount of capital deployment, and we will selectively take some risk for portfolios in that manner. I think one of the most interesting things about private equity and good GPs, good managers, is that they're able to see value ahead of the curve and be able to capture it through their investment process. It doesn't always mean it's the same thing cycle in and cycle out. And one would have never expected the amount of credit that's been raised over the course of the last 24, 36 months because of the crisis period. We're comfortable with smart managers that are able to capture value in unique, dislocated type of circumstances. And so it doesn't always have to be that they've done the same thing, but we do need to see some level of demonstration and some confidence factor that they are able to create a multiple of capital and they're doing it smartly and without an added level of risk. There's certainly been a trend towards slightly smaller pools of capital that general partners have been raising. And in fact, in many instances, I think this is better for the general partner's investment strategy, and have had many discussions around coming off of the heady days of 06, 07, 08, and investing very quickly. It is that back to basics. We like to see that. I'm more than happy to have a $5 billion fund become a $2.5 billion fund and get back to their sweet spot of investing. At the same time, you're seeing that across the market. Part of the real challenge on the LP side of things is that you used to walk down to the corner store and just get a buyout fund that would do a lot of things for you, but now it's more like walking into Costco. And there's an enormous amount of opportunities out there, and it really is a burden, and the ability of a general partner to differentiate and really demonstrate why what they're doing is different and is going to be value added in a portfolio context is going to be very important. It's an interesting translation going from the LP side to the GP side of things. And one would question probably who started that new creativity, that new kind of fluid interest in different types of investments, different types of capital, because to some extent, many GPs are on the forefront of saying, look, I need to diversify my business. I've had hiccups coming through the market, and There's niche strategies, there's other places I can raise capital, the funds are a little bit smaller. What else can I do to diversify and truly stabilize my underlying business? And you're not just seeing this in the global mega managers. You're seeing this in small funds as well. So while many of the global managers, for example, have raised an energy fund over the last 18 to 24 months and capitalized what has been a niche sector of their investment strategy, which has done quite well for them and subsequently done well for many of their investors, you see venture capital firms doing this as well, and they may be a healthcare venture firm overall, but they're now raising very niche capital for a non-tech specific type of healthcare investing. And so across the board, general partners are saying, look, I'm seeing a little more flexibility in the capital that is available out there. What else can I do to enhance my underlying value and my value for investors? Historically, some of the really heart of private equity capital has come from the endowments, the public pension funds, and I think that new beat is really coming more from government agencies, for example, sovereign wealth funds, and even family offices. And they're looking at private equity in a different way, and they're really willing to mix it up and say, I want more, I want a different structure, I'm willing to go in different regions, even to go across asset classes. And so I would say that basic, old, perhaps common fund-to-fund type approach where you're saying set buckets to invest across asset classes and you're really filling those out, that's a bit passé. Customization, everybody wants to be customized now. Whether you're a $25 million investor annually or you're a $2.5 billion investor, people want a customized program, and that continues to translate into more interesting, fluid type of capital, co-investment across asset classes. You know, certainly post the GFC crisis, the distressed credit sector has blossomed. And I think that was really the start of saying, look, we can do more things, we can capture our relationships and really create value. This conference has just grown tremendously. I've been attending for the last 7 years, and it's such a pleasure to be able to see the growth in the women and the experience and the networking that's really available here on true in-depth topics. When we're looking at women in the private equity field, as a firm, we have a very active gender diversity approach. And if you look at us, 2 of our 8 investment committee members are women. As you kind of look down through the firm, we find that the inclusion of different perspectives makes for a better decision making. And so when we do look at managers from the investment side of things, I like to see the diversity of the manager. We don't have programs specifically set up to say, I'm only going to invest in a woman-managed firm, a woman-founded firm. But we do like to see smart women participating in the asset class, and we back smart investors. And so if women are participating through an established private equity firm, or spinning off and doing something on their own, and there's been many women here who have done that quite successfully with a large amount of support over the years, we're certainly a fan of that. We like to back good investors.